Okay, so how to trade the news. Let me just need to dock this back. Okay, just a quick disclaimer before we begin. Please keep in mind all comments I make are for educational purposes only, and you all know there's a high degree of risk involved in all types of trading. Now, very important, don't try and do too many things at once. Focus on what I'm going to cover today. Turn off any distractions, close the door, turn your phone off. Don't answer emails, just focus, and this might be a big eye-opener for you into the world of professional trading. And again, Dan, you gave me a great introduction, so we can move on from that. And I like to start all my presentations this way because most people, when they start out trading, don't treat it like a business. So the first thing that you should know is trading is a business. So treat it as a business like you would any other business. And I like this quote, hobbies cost money. Businesses make money, especially successful businesses. So you want to be in the category of your trading making money. So you must approach it like you would approach running any type of business. Okay, most people start out the wrong way, build bad habits, and then spend many years trying to break those bad habits and then give up due to, an immense amount of frustration. What is very, very simple, which is trading, is made very complicated by ourselves. We start out and it looks very simple, and then it becomes very complicated and we get involved in all types of things that we need to work on in order to succeed. And then eventually when you finally get there, it is actually simple, but not easy. It gets back to that original simplicity that you thought it was when you first started, but there's a journey you need to go through. So this is what we're going to cover in this session. We're going to do a quick introduction to chart reading. Again, I'm assuming that there are people watching this that don't know anything about trading, and right up to more advanced people that have been trading for quite a number of years. So I want everyone to be on the same page. So I'll quickly go through from the beginning, and we're going to build deeper and deeper into it. So again, every step's very important to build this framework that we're going to build of how we're actually going to trade the news. We're going to go through supply and demand because that's what drives any type of market. And we're going to look at reward to risk. Then we're going to talk the particulars about trading the news and how you go about setting up to trade the news. And then I'll open up for audience questions and answers. And if we have any time at the end, we're going to do some live market analysis. And then I'll share with you an offer right at the very end. An offer I'll tell you now is to join our live trading room. So I'll go more into the details for that at the end. So first things first. If you're a technical trader, stage one is learning how to read the language of the markets. Those are charts. You have to learn how to read the charts over here. You have to understand when you look at this what it means. Now, one of my traders recently told me, when he started trading, he looked at the charts. It's very exciting when you go into, onto the trading floor and you see all these screens and all these, colorful things going on and, on the screen and things flashing and everything. It's kind of enchanting. It's exciting. That's when I entered my first trading floor was on Credit Suisse in London. And, it was a kind of an exciting place to be, especially during the World Cup when no trading goes on and everyone comes in the, wearing the uniform of whatever desk they're working at. So 2 weeks during the World Cup, everyone's watching the screens, but watching the football, the soccer, yeah? So this is, what you need to learn how to do at the beginning. Again, even if you were to approach the markets from a fundamental perspective, fundamentals don't tell you how to enter the trade and how to manage your risk. Fundamentals might tell you whether something's overpriced or underpriced, but it won't tell you how to manage your risk. It won't tell you how to time your entries. So that's why technical analysis or reading the charts is so important. And recently I was in New York and I spoke to a friend of mine who actually speaks in all the news wires. And he said to me a very interesting comment. He said to me, technical analysis is fundamental analysis. He says the technical analysis is fundamentals. I always thought there was technical analysis and fundamental analysis. But actually, a lot of people now understand the importance of reading charts. So the first step to becoming a successful trader is to learn how to read the markets like a pro, like a professional trader reads the market. And I'll explain more what that means as we get into it. There are many indicators out there. There's many different lines and studies that you can add to your charts. I tried almost everything. But there's nothing more simple than understanding how to read price charts without any indicators on. Because most indicators, actually all indicators, are based on price. So if you can learn how to read price and what that represents directly, you don't really need indicators. We use, and most people nowadays use, Japanese candlestick charts. So what we're going to do is go over a little bit about candlestick basics. So everyone's on the same page for those people who have never seen a candlestick chart before. So let's go into Japanese candlesticks. Japanese candlesticks, they represent, each candlestick represents 4 prices, represents the open, the close, the high, and the low of whatever time period that candlestick is on. Whatever chart. For example, it could be on a 1-minute chart, and this represents what happened during 1 minute. Where did price open at the beginning of that 1 minute? Where did it close? And what was the high and low for that period? This is called the body of the candlestick. These are called wicks or shadows. Candlesticks have wicks, yeah, but you can call them shadows as well. And if price closed above the open for whatever time period you're on, call it the 1 hour now, then generally it will paint the candlestick green. Again, you can pick whatever color to represent closing higher than the open if you like. Some people used to use black and white, but people use blue and green, whatever you want, as long as you understand what it represents. And likewise, if price was to open up here and close below the open for that time period, for that 1 hour, then the candlestick will be red. And this is the high and the low. Again, the high and the low can be the same as the close. The close could be the same as the low, and therefore there would be no wick or no tail or no shadow, whatever you want to call it. So everyone's following that? Just type yes in the chat box if you're following that. Everyone's on the same page. Okay, so let's move on. There's 2 very important candlesticks that you need to learn. Again, there's many different candlestick formations that you can learn, but these are one of the 2 most important ones. Does anyone know what the one on the left is called? Just type it in the chat room or type it in the question area. What's this one called over here? And what does it represent? I'm looking in the questions area and see you guys typing something. So just type in that room if you know what this is called. Second, I'm just see if I can actually see that. Okay, I can actually see it at the end. Yeah, this is called a hammer. Yeah. Now, generally, a hammer is a bullish candlestick, but not always. It depends where it is and what the context is in. So generally, if you're in an uptrend, for example, and you have a move down to a demand area, to a support area, and you see a candlestick like this, it may indicate that price is going to turn to the upside and continue in the uptrend. Again, you've got the context, it's uptrend, you're in the location, in demand, and it's an indication that the price may move higher. Now, again, sometimes you get a candlestick like this, it's actually bearish, it's the exact opposite. So if you don't know how to read them in context, over time, through experience, you'll get to learn when not to buy on one of these, when actually to sell on one of these candlesticks. And again, that's getting a bit too involved for now, but we'll move on. So this one's called a hammer. And the one on the right is actually called a shooting star. Okay, so well done for those who answered correctly. And again, a shooting star in the right context is a bearish reversal candle, but not always. Sometimes you can have a candlestick like this. For example, I'll actually give you one example of this. You have a supply zone in the market, and we're going to go into supply and demand soon. And you have a candlestick like this that pierces above the supply zone. In that context, this is a bullish candlestick and means that price is likely to continue moving higher. So for those of you who have any trading experience and the book says sell on one of these candles, it's going down, and you sell and then you get a big green candlestick happening straight afterwards, let me know if that's ever happened to you. Yeah, just type yes if that's ever happened to you before. That you see a candlestick like this, after a bunch of green candlesticks, you get a candlestick like this, and you sell, so you get a little bit of a move down, it's a bit red, and then you get a reversal and it goes solid green. And you're like, what on earth just happened there? So when you learn candlesticks in a deeper way, I'm not sure if the books actually teach you this. There's the books, and then there's reality of what actually works in the live markets. And that's based on my many years. I've been trading now for over 12 years full time. So that's based on actually what works and what doesn't in the actual live markets that we trade every single day. And you start to, if you analyze your trades, understand, if you analyze, say, 100 trades like this that didn't work, that didn't go down, that went up, you start to understand what the commonalities are between all those trades. And then you have a deeper understanding of how to read the market. Because sometimes when you get a candlestick that's bearish and it doesn't follow through, it means it's bullish sometimes. Okay, and understanding those scenarios is very, very important. So let's move on. Supply and demand. Why is supply and demand so important? And why am I talking about supply and demand? So let me tell you a little story about when I started trading on the trading floor of generic trading in Philadelphia. We learned a methodology of trading where we would analyze the time and sales, which is where what you call a print happens when there's a trade, an agreement between buyer and seller to take a trade. Then it's printed, the time and the amount, the quantity, how many shares, yeah, went off, and that's the time and sales. And then you have the open book, which is all the orders above and below the market, call it level 2. You have a level 2, and you have an open book, which is a specialist like level 2 with all them. So you have the market makers, and then you have the specialist in that stock has his own book called the open book. That's the way that we traded the New York Stock Exchange. So we were taught a methodology of trading based on understanding or analyzing what the specialist was doing, because the specialist is the ultimate day trader. They see the order flow. And they're the buyer and seller of last resort. When a stock gaps up, who's on the other side selling if there's not enough supply in the market at that level? The specialist is the one who decides where the stock is going to open every single day at 9:30 a.m. Eastern time when the New York Stock Exchange opens. If there's a huge certain number of buy orders at the open and there isn't enough sell orders on the other side at that level, the market will gap up. There's not enough supply to fill. And if there's not enough orders higher up in the market to fill the demand that comes in, then the specialist will have to be the seller of last resort. And the specialist is not going to lose money most of the time. Otherwise, they'll be out of business. So they're going to sell it at a price whereby they can make money, as in it's going to likely drop after that, and they'll be able to take the other side and buy back what they sold higher. So what was very important, the way that we were trading them was based on understanding the specialist. Now, the specialist was a human being back in those days, like 12 years ago. And what happened was the New York Stock Exchange went hybrid. The specialist system went hybrid, part human, part computer. And I think maybe nowadays it's almost all computer. And so the system that we were trading, identifying what the specialist was doing by watching the prints and how they were going off on the time of sales, what orders were being shown on the open book, and what was actually happening. So, for example, if there was an order on the open book on the buy side, but the print went off like a few pennies higher, maybe the specialist was stepping up to buy, so we should buy. So we're identifying what's happening, for example. And that system stopped working. As soon as the specialist system went hybrid, the way that we were trading didn't work anymore. So I had to go back to the drawing board after trading this way for a number of years, and to build a way of trading that was timeless, that would stand the test of time, that wasn't based on any technology, that wasn't based on something that works now and wouldn't work in a few years' time because of some changes in whatever, in the structure of the New York Stock Exchange or technology or anything for that matter. So if you go back to first principles, supply and demand is what moves any market. So if you build your trading system on a timeless methodology, supply and demand, then what works now will work tomorrow and the next day and forevermore. Does everyone understand that? So you want to be able to trade a methodology that you don't have to keep changing because something else changed. Once you learn this way of doing it, you'll never have to learn anything else ever again. You don't need anything else once you learn this way of trading. So what is supply and demand? What is it? So everyone knows the general principles of supply and demand. Price moves higher when there's more demand than supply. When there's more willing buyers at a certain price level than sellers, prices will move higher. Now, people incorrectly think that there's more buyers than sellers. There can never be more buyers than sellers, more buying going on than selling. Let's put it that way. It can't be there's more buying going on. People think, oh, price is going up because there's more buying going on than selling. Every single trade is a buy and a sell. If someone bought, someone must have sold it to you. If someone sold it to you, there must be someone on the other side buying. It doesn't go nowhere. There can't be more buying going on than selling. What they mean is the more willing buyers and sellers. Not every buy order will get filled if there's more demand than supply. Prices will rise and leave some orders behind that are not filled. For example, if you ever trade and you want to buy at a price and you hit the button maybe with a kind of a prerequisite on the order that you don't want to be filled more than 3 pennies higher, and you hit the button and you don't get filled at all because prices have run away from you and you don't get the price that you want. So you're a willing buyer that didn't get filled. That's what demand is. Prices rise. Everyone's jumping in to buy, but there's not enough willing sellers at that price. Once the sellers are out of the picture, the price will jump to the next level above where there are still winning sellers. That's how prices move in the market. And on the other side of it, prices will move lower when there's more supply than demand. So you have markets trending higher generally when there's more demand than supply, and trending lower when there's more supply than demand. There's another type of market. Does anyone know what that is? There's 3 types of trends. But then there's also markets that are somewhat not trending up, not trending down, and correct, not consolidating or sideways. Well done, Michael, Matt, Amit. So yeah, you do have sideways moving markets. And again, when you have supply and demand in equilibrium, the same number of willing buyers and sellers, then prices will remain around the same level until one side increases over the other. Now, let me ask you a question. What moves markets? Based on what we've just said now, what moves markets? And this is a very, very important question because why is it so important and fundamental? Yes, you're right, Nafisa. People move markets. But what do people do that moves markets? Because I can have a bunch of people and they're not doing anything and the market's not going to move. What are they doing? Yeah, people psychology, correct. But what's that causing? Yes, exactly, Mr. Johnson. Yes, they actually need to buy and sell. Again, what is that? When someone puts an order in the market to buy, that's demand. When someone puts an order in the market to sell, that is supply. That is willing buyers and willing sellers that are not yet filled. Once the order's filled, that's it, it's gone. There's nothing you can do to influence the market once you've already bought it to go up. What can you do when you've bought a stock or whatever you're buying, a futures contract, a forex pair? What can you do after you've bought it? Say you've bought your maximum size that you can buy. What do you do now to make price go up or down? Anyone? What can you do to cause price to go up and down? Guess what? Absolutely nothing. There's nothing you can do now. So once you're in the trade, there's nothing you can do to cause prices to go up and down, even if you've got your maximum order filled. But before your order's filled, you can influence the market if you're big enough. So basically, what moves markets? It's supply and demand. It's those unfilled buy and sell orders. And guess what? There's something very interesting about supply and demand. That will never, ever change. What causes supply and demand in the market? Well, that's a different question. So there's, many different reasons why someone might be buying or selling a stock or a forex pair or whatever. Trying to understand the reasons is kind of, as a technical trader, is a bit futile because there's so many different reasons. And if you're trying to look into the fundamentals, for example, you might not be privy to all the information out there that you need to know in order to make the correct analysis, whether something's overpriced or underpriced. So knowing that you have a methodology, for example, once you understand supply and demand, and you're thinking now, what's that got to do with me in trading? Well, guess what? If you can identify supply and demand on the charts, where are those orders sitting on the charts that aren't filled yet, then you can know with a high level of probability where markets are going to turn to the upside or the downside. So this is laying the foundation to not only how to trade the news, because generally in news trading, the market plays out as it was going to play out before the news, if you know how to read the market, but it happens quicker. So you need to be trading quicker. It's like playing a video game on level 1 where everything's going slowly, and then you switch up the tempo up. You're on level 10 now, everything's moving quickly. You have to make really, quick decisions. As in, you almost have to bypass the decision-making process, and it has to almost be a reflex. And that requires training. Unless you set your orders ahead of time, which you can do as well in certain locations in the market, and we're going to go into that shortly. So this is setting the foundations of what you need to do in order to trade the news and trade any type of market, not just the news. So one of the important things that you need to know before you trade anything, especially the news, is your strategy profitable? You must have a trading plan. I mean, just type in the room anyone who just type no in the room now if you don't have a trading plan, or type yes if you do. Just type in the chat area, in the questions area, if you have a trading plan. Okay, so we see we have a no, we have a couple of yeses. Okay, well done, Tim, Matt, Christian, you don't. We have me for now. I have one, okay. Okay, that's great. So yeah, so a trading plan is very, very important. And part of the trading plan is to have a strategy. A strategy isn't a trading plan. A strategy is part of a trading plan. So within your strategy, you need to look at various factors. For example, you need to look at risk. Before you take any trade, you have to know what your risk is on the trade. And that's generally defined by the chart, but also by your money management rules. People can say, oh, this trade is risky. Well, You decide how much money you risk on every trade by position sizing. And you also have to look at reward. So for every trade, saying, I made this many pips or I made this much money is meaningless, because you need to look at how much you're making compared to how much you're risking. That's a more correct view of your trading and your trading results. And then you need to know what your average winner is to average loser. That means, what is your average winning trade? If you look at all your winning trades, is your average winning trade $100, but your average losing trade is $200? And therefore maybe you're not, and maybe you're not profitable. Or is it the other way around? Maybe your average winner is bigger than your average loser, which is a good thing. And then you have to look at batting average. How many of your trades end in profit or reach their targets, as opposed to compared to how many of them hit your stop and stop you out if you're using stops? Why is that so important? Because most people trade incorrectly. Most people, and you tell me if this happened to you, because it certainly happened to me at the beginning, that every single trade was a matter of life and death. It's got to work. I'm seeing the charts and I'm putting this trade on, and it's got to work. And I take too big a size because I didn't know too much about position sizing, and I'm going to make a lot of money on this trade. And it starts moving against me a little bit. And all of a sudden the market collapses and I'm sitting in a position staring at the screen, frozen. Has that ever happened to you? It doesn't feel very good. That's how a novice trader trades. Take too big a size, expecting the trade to work, and if it goes against you, oh dear. No, that's not normal, Milo. So how about a different way of doing it? At the beginning, when you take a trade, don't have any expectation whether the trade is going to be profitable or not. It's like flicking a coin. It could be heads, it could be tails. That way, you're not emotionally tied to that trade. And one trade alone is very important that you know this, is meaningless. You have to look at a number of trades, at least 20 trades as a correct sample size to know whether your strategy is working. And this is the important number that you need to look at. You need to look at something called positive. You need to look at a number called expectancy, and it needs to be a positive number. Because if it isn't a positive number, if you carry on doing what you're doing, the more trades you take, the more money you will lose, even if you have winning trades. And as developing traders, most of you will know that you might have the odd big winner, but guess what? Over time, you're still losing. And you'll remember those big winners and think that you're a great trader, but guess what? The bottom line P in your profit and loss curve is going down. It might have a few spikes up, but it continues to go down as you lose money consistently. And what you need to do is be the opposite. You need to have a profit and loss curve that's going up with the occasional dips as you go through losing periods or losing trades. But the general trend needs to be up, not down, okay? How do you do that? It's something called expectancy, and that number needs to be positive. That's why you need to look at things like reward and risk and average winner to average loser and your batting average. How do you calculate positive expectancy? Very important and very simple. You just need to know 4 numbers, or actually 3. You need to know what your average winner is, and you need to know what your average loser is in dollar terms. And then you need to know what your batting average is. And obviously, if you're batting at 50% or 60%, then your win rate will be 60% and your loss rate will be 40%, 100 minus whatever your win rate is. If it's 50-50, you can only be positive if your batting average is your average winner is greater than your average loser. So this is what's very important. We'll go through a couple of examples soon, and you'll see out in the internet, if you do a search, you'll see people selling strategies. Take this strategy, it's right 99% of the time, and guess what? It still loses money because 1 in 100, you have a huge loser that wipes out all those winners. So it's not a winning system. You need to know not just what the batting average is, you need to know what the average winner to average loser is as well. And here's the most important. You can have a winning system. It could work for everybody else, but guess what? It doesn't fit you. Everyone else can walk the tightrope between two, mountain tops without a safety net, but you can't do that. 100 people can do it, but you can't do it. It doesn't fit you. It's not fitting your personality. It's not for you. So this is why it's very important to develop a strategy that fits your personality. And especially true when it comes to news trading. You might want to come and learn how to trade the news, but it might not fit you. It's very fast and furious sometimes. And yes, you can make a lot of money very quickly, but you can also lose a lot of money quickly as well on the other side of it. So you have to develop a strategy that fits your personality. The way we train all our traders is to teach them a framework in which to read the market based on supply and demand. Trends, if you're in an uptrend, then generally you're going through periods, an uptrend forms when there's more demand than supply until there's a little bit more supply than demand. You have a little pullback and then it continues. The buying increases again and pushes the market higher. That's an uptrending market. And likewise, downtrending markets are the reverse. Sideways markets when you have equal supply and demand. Buyers push it up, sellers push it down, and you have this kind of seesaw. And if you learn how to read supply and demand, you can anticipate those periods in the market when it's most likely to go sideways, and you can adjust the way you trade accordingly. So in trending markets, you want to basically let the trade run. It makes sense because you don't know how far it's going to go. It's trending. Let it keep going. Whereas in a sideways moving market, you don't want to keep letting it go. You want to take your profits sooner, because if you keep letting it go, it's going to come back and stop you out or go back to your entry price. That's a sideways moving market. So you have to know what type of market you're in and what you're likely to move in. You might be in a trending market now, but likely to move into a sideways market, consolidating, choppy market. So knowing how to read the market is key to understanding how to actually trade it. And if you have a great understanding of how to read the market, you'll have confidence when you trade, because you'll understand what the market is doing as it's playing out. No one knows what the market is going to do. All you know is that in certain scenarios in the market, something's more likely to happen than something else. That's called an edge. And you play your edge. Now, once you've got a framework of how to read the market, you can build whatever strategy you want, whatever time frame you want. You can build whatever management policy you want that fits you. And that's what's so important about building a strategy or a trading plan that fits you personally. If you go back and look at your trading and you find that you're trading a system that you can't seem to do, maybe it doesn't fit you and you need to adjust. And if you don't know how to do that because all you did was learn to play one song on the piano and you don't know how to read music and you don't really know how to play piano, so you can't adapt and adjust to different, to play something else, for example, then you're pretty stuck. You become, very narrow in your focus, and you can't, have any transferable skills from that you can transfer and develop your own strategies. All my traders can develop their own strategies and know how to test the strategies to prove that they have positive expectancies, and then they can trade them with confidence in the market without fear. And we'll talk a little bit about that as we go on. Fear is a very important thing that you need to minimize, and you have to replace that with confidence and accepting the risk on every trade. Let's move on. So let me give you an example of a few profitable strategies from a conceptual perspective. So here's the formula again for expectancy. You can have a system a strategy that produces 50% winners. So you know ahead of time when you're trading a system like this, that half of your trades are going to be losers and half of them are going to be winners. So why would you, try and make every trade a winner and trade with the mindset that this trade has to be a winner, when you know that half of them are going to be losers, but you will still make money because your average winner is double your average loser. So if you were trading a system, for example, flicking a coin heads and tails, and you were risking $100 per trade, and on a winner, for example, tails, you get $200, and on a loser, heads, you'll lose 100. You don't know how it's going to play out. You may get head, 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 and then tail, head, and then tail, tail, tail. You don't, oh, it could be head, tail. But you know, over a large enough sample size, you will have 50 heads and 50 tails. And if you make more money on heads and tails, you'll have a positive expectancy of $50 per trade. So the more you trade, the more money you'll make. And losing trades are part of that winning system. Isn't that a good thing to know ahead of time when you're trading something, how many times you expect to have losing trades? But if you know you'll come out of ahead at every single trade, you'll take every single trade. You won't skip a trade saying, oh, my last one was a loser, why didn't I take the next one? I'm not going to take the next one when my system tells me to take it, because the last one was a loser, maybe this one will be a loser. It's like saying flicking a coin, and I got heads last time, I'm not going to flick it just in case I get heads again. Well, you've got a 50-50 chance every single flick of a coin to get heads or tails. Does everyone understand that? And that's how ridiculous we get sometimes if we actually, when we're trading, that we have to make every trade a winner. And we trade as if that every trade has to be a winner. I'll give you an example of personalities of people that are very successful in other areas of life that find it very difficult to become a trader, because a trader has to really change their whole belief system, because the general belief system of human beings out there doesn't work well for trading, the way that we grow up and learn things. For example, a doctor's taught to save the patient whatever, at whatever cost. Now imagine transferring those skills to the market. You have to save this trade at whatever cost, as in blow your whole account out to make this trade work. It's difficult to tell, to make it very crude. If the trade doesn't work, kill it. You're not going to, a doctor doesn't work like that. So therefore, those skills that you have as a doctor don't transfer well into the trading arena. And likewise, a great lawyer, for example, may be able to turn an innocent person into a guilty one, or a guilty one into an innocent one, by arguing a good argument. So you'll try and convince yourself, whatever reasons, that the trade that's going against you is going to actually work because of these factors and this factors, when the real truth of it is it keeps going against you. So those skills are not good for becoming a good trader. And why am I saying this? Because it's it becomes very heightened when you're trading the news, when things are moving much quicker. Here's another example. You can have a batting average 25%, as in you're a loser the majority of the time. Only 1 out of 4 trades is a winner. But your average winner in this case, you may be a trend trader, for example, is 4-1. So your average trade that's a winner makes $400 only 25% of the time, but you lose $100 75% of the time. Your expectancy there is $25 per trade. That's what you expect to make. So therefore, these are examples of two systems, one where you've got 50-50, you're going to be wrong half the time, and this one you're going to be wrong 3/4 of the time, but you're still positive. So if I were to give you this system and say, just follow the rules exactly how they are, and hopefully they fit your personality, would you be able to do it? Would you be able to sit through 3 losing trades before you get a 4th one? How would you feel? You start trading, like most people do, with a great system, and they'll take 2 losing trades at the beginning, and they'll say, oh, this system doesn't work, and they'll go back to the internet and do a search of who's got, who's got a batting average of, I don't know, 80-90%, because I can't, So you take that system and you start taking the trades, and guess what? The first 2 trades in that system are both losers as well. And then you're like, I'm a bit stuck here. What do I do now? Tell me, just type a yes in that room if you've actually done that. You start shopping around for the next best strategy or the next best system that's going to make you a millionaire without doing any work, and you start trading it, you buy it off the shelf or whatever, and you start trading it doesn't work for you. You don't give it enough chance. You don't let it, you don't give it enough tries, enough tests, enough trades. Yeah, has that ever happened to you? Yes, Chris, I think this has been recorded. So let's take this on now into the news. how do you trade the news? What do you need to know? Okay. So you need to know, the first thing you need to know is, when are these news events happening? You need to know when news events. You need to know the timetable. So you, for example, can look at, there's many different news websites out there. I can pull up one to show you now. Let me just pull this up here. You can use Forex Factory, for example, and you can have a list today and you can see what time the news is on Eastern time, what time news is happening. You can look tomorrow, for example. You can see, you know, there's unemployment claims happening 8:30 a.m. So that might, you know, you've got the Fed chair Yellen's testifying and other different things, FOMC members speaking. And you can see when news events are happening and you can prepare for them. Sometimes on news events, you get a lot of volatility. The markets start moving quickly to different levels, which we're going to talk about soon. So you need to know a timetable when the news event's happening. Don't just turn up and without any preparation and trade. Actually, don't just turn up and trade at all anytime without being prepared. Okay, preparation equals confidence. Confidence means you're trading without fear. You want to replace the fear with confidence. If you're not confident with what you're doing, you'll be afraid. And if you're afraid, you won't see things that you need to see because your focus narrows and you're not able to take in what the market's showing you, the opportunities. You'll just see everything that's relevant to getting yourself out of that fear situation. And then what most people do is get themselves out of the trades, and then they start to see what they should see in the market. So be prepared ahead of time. Don't just come 2 seconds before the news event and sit down and like start trading randomly at the market, because most likely if you hit the buy button, you'll get filled at the high of that whole news period. And if you hit the sell button, you're probably likely to be filled right at the bottom. And as soon as you get filled, the market rockets up against your position and you're like, what just happened? The news was bad, I sold, and then the market kind of jumped down and then it reversed and went much higher, and you're like, what just happened to me? Has that ever happened to you? Just type yes in the room now if that's ever happened to you, and you're like, your head's spinning and you've got no idea. You just thought you're just going to make a lot of money on this, and what just happened to me? And we're going to go into that. Yes, Amit, Matt, Christian, Sam. Yeah, it's happened to me too. And it's like you seem to be being bashed around by the market. It feels like that, doesn't it? So you have to take control back. Okay, it's not the market's fault. The market's just doing what it does. The market's the market. The market doesn't know you exist. You have to provide the structure. You have to provide the structure by being prepared ahead of time and knowing exactly what you're doing and having tested it and tried it and traded it before, small size, to prove it works, and then you can scale up. Don't start putting big money in the market if you don't have if you haven't proven your edge or proven that you can actually do it. So let me ask you a question now. Does news move the markets? Just type yes or no in the room now. Does news move the markets? Yes or no? Okay, so we have yeses coming in. Amit, Michael, Sam, Matt, Raymond. Okay, so we have everyone saying yes. I haven't seen any no's yet. Yes, we have no. Great, excellent. So guess what? Does news move the markets? The real answer to that is no. And let me prove it to you. For those of you who think that news moves the markets, there's a pharmaceutical company called ABC Pharmaceuticals, we're just making it up. And they come out over the weekend with an announcement that they found a cure for cancer. One pill, it's going to cost about $100, pretty cheap. And you take it and your cancer's gone. That's great. So what's happening now to the price of ABC Pharmaceuticals? There's great news. What's happening to the price of the stock? Guess what? It's weekend, nothing. So there's great news and the market's not moving because it's closed. What's going to happen when the market opens on Monday morning, it's probably going to gap up as there's a huge number of buy orders, yeah, that are coming into the market to buy this stock, buying on the news. Yeah, there's great news. I want to own the stock. So what happens on the day of the market? The stock gaps up to $150. It was originally like a penny stock or whatever. Maybe it was like a $10 stock or whatever. It's gapped up to $150 a stock, and the rest of the day it goes down, down, down. You get filled at $150 on your buy market order, and the rest of the day it's going down. And it closes the day at $100, and you just lost a third of your money. You put 100,000 or whatever, let's make it, you put $90,000 into the market, and you've just lost $30,000 in one day. Oh dear. So what moves the market? It's people. People move the market by making trades. The news causes people to buy or sell. But doesn't always mean that there's good news that the market's going to move up. It may gap up and then go down the rest of the day. And I'm sure if those of you who've had a trading experience are well experienced at that. So this is a very important fundamental belief that you need to have. We do not trade the news. So if you're coming to trade the news and trying to look at the reports and understand whether it's going to go up or down because earnings came in better, or Yellen said this, or the Fed said that, or I don't know, there's the oil reserves are less than what they expected, or companies reporting, better, or, retail sales were higher than expected, or whatever it is. Yeah, we don't trade the news. So what do we trade? We trade the reaction to the news. So if you look at the market and you see what's happening in the market, that's the reaction. That's the charts. That's the footprints of money. That's what's really happening. That doesn't lie. Trying to understand the news and dissect it and have an idea of what the market's going to do based on that, and then trading accordingly, what has that done for you? If anyone who's ever tried that, what have the results been? Probably less than satisfactory. Maybe consistently losing with the odd winner. So therefore, instead of looking at the news and trying to predict which way the market's going to go, how about looking at the market itself and understanding beforehand where the market may move on the news, and be ready and waiting ahead of time, no matter what the news is? Does that make sense? So the news causes a reaction in the market. It causes a buildup of buyers or sellers or whatever, yeah? And the market moves based on that. So it doesn't matter, what I'm saying is it doesn't matter what's causing the market to move. If you know how to read those moves, you can trade the news. The news just makes things happen quicker. So how do you prepare to trade the news? So you may have some routines you need to go through. You need to have some preparation. There's a few things that need to be ready before you trade the news. You need to be, number one, ask yourself the question, am I ready to trade? You need to be not just running into your office or doing it from your phone on the bus or stopping at the side of the road in your car to take a trade. Don't try doing it and drive at the same time. Not a good idea. And you need to make sure that you are in what we call the zone, that you're prepared and that you're in a frame of mind that's conducive to trading, which is a high performance activity. For those of you who've tried it, you have to make sure that it's a peak performance activity. You have to make sure that you're performing the best that you can. So you may need to make sure that you're ready. Now, I have my routine that I go through. I go for a swim every day, and I used to do a bit of meditation beforehand, and I go through a market preparation. For those of you who trade with me in the trading room, know my routine. We do it together every day. So That's what you need to do. You have to say, you have to be ready, and then you have to ask the next question, is the market ready? You can look at the market once you know how to read it in a simple way and know whether the market is set up or not for trading the news. Not every market is set up, and sometimes you have news and you can't trade them with a high degree of, with a high probability, with an edge. So you don't trade that market. You have to know what it looks like. And then you have to prepare everything ahead of time. And then you need patience. You have to wait for the market to come to you on your terms and conditions. Because guess what? If you go to the market on its terms and conditions, you've lost. You have to let the market come to you on your terms and conditions. And you have to know exactly what that is. And you need discipline to follow your trading plan. That tells you exactly what you do in every scenario the market's in. And you'll have a plan for trading the news, and it will tell you to do this, this, and this. These are the steps you go through. This is what I need to do to be ready. Now I'm ready. News comes out. I'm all ready. Bang, I'm in. And I know exactly what I'm doing when I'm in. I know exactly what I'm risking. I know exactly what I'm getting at. I know everything ahead of time. You cannot go into the market without having a plan of action. And I know as a cliche, as the saying goes, if you fail to plan, then you plan to fail. It's true. And you have to go back, as we said before, you have to run your trading as a business. You have to know, in this situation the market's in, when this news comes out, what's likely to happen and what am I going to do depending on what happens. Be prepared ahead of time. And the final thing, which is one of the most important things, is having your psychology and emotions in check. Because that is what's going to trip you up. Even if you have a plan that produces a positive expectancy, your emotions, if you're not in the zone, so to say, will get you doing things that you look at afterwards and you say, why did I do that? The trade's going in my way. It goes a little bit against me and you get out, and then it's a huge move to the upside if you're on the buy side. And you're like, and it goes all the way to your original target and you're not in the trade. Why? You got scared because it went against you. But that's normal. The trade meant to go against you. It's not going to go in a straight line. And knowing that ahead of time, that most trades, most stocks, or most any instrument that you trade doesn't go in a straight. It would be nice if you actually entered any trade and it would go, you're a winner, or you're a loser straight away, you know, and save you all the, you know, watching it as it plays out and goes up and down and does whatever it does. Very, very important. So make sure that you have routines in place, that you're prepared to trade, that you're prepared, that the market's ready for you. You have to be ready, the market has to be ready, and you have to have a strategy in place and a trading plan that engages that market condition. And you need to have patience and discipline. You can't have discipline as a trader if you don't have a trading plan. Discipline is defined as the ability to follow a set of rules. If you don't have a set of rules, you can't be disciplined. And most people aren't born disciplined. It's something that you have to develop. Most people might think they're disciplined, but give them a set of rules and tell them to start trading, and you'll see that the results will show otherwise. I almost haven't come across anyone that's been 100% disciplined, that follows the rules all the time. You know, at the beginning, it's very difficult for people to get themselves to do what they know they need to do. And it's kind of frustrating. You know you need to do it, but you're kind of, something's getting in the way there. That's your psychology and emotions. So you have to work on that and build the correct belief system so that your action in the market is correct. And the bottom line is, look at your trading results. If you don't have a positive equity curve, if it's not going up, if you're not making money over time, then you're doing something wrong. And if you keep carrying on like that with the hope that you're going to be profitable, and and you don't do anything to change, and you don't even know what you need to change, then you're not going to get there. You'll go for years and years and years, and you'll still have, flashes of success because you have a winning trade, which happens to, it can happen to anyone. Anyone can take a winning trade. And then you think you can do it, and then you end up losing again, and then you have another flash of inspiration or whatever with a winning trade, and you think you can do it, but in the meantime, you're losing money all the time. The equity curve is showing something different. So you have to figure out, if something's not working for you, what is it, and what do I need to do to change? So how do you trade the news? Well, market looks something like this maybe before the news. And what you need to do, as we said at the beginning, is to identify those levels in the market where there's more willing buyers than sellers. Because guess what? For example, if I identify this level, remember demand, or what if you can call it support, it's not one price. It's not like join the dots and it's one line. No, professional traders don't buy at one price. We buy in zones. You know, you can buy this zone. And how do I know there's more willing buyers than sellers here? Because prices went up. If prices go up, I know one thing about the supply-demand equation. There's more demand than supply, by definition. You can't argue with that. So, and likewise, if prices go down, then there must be more supply than demand. So if the market's sitting here before the news, for example, and you want to trade it, maybe what you could do, and you tell me if this has happened to me, we said this before, good news comes out, so the market runs up here quickly. You hit the buy button on the news and we go here. What happens, you get filled here in this level, and then the market drops all the way down, and you're like, what just happened to me? And you said, those of you who answered, yes, that's happened to you. And, or for example, there's bad news that comes out, so you hit the sell button, and the market goes down here quickly and fills you here, and then runs up. So how about approaching the news this way? I'm assuming now that you can identify supply and demand errors. That's what we teach in some of our training, how to go about identifying. And there's 10 different types of supply and demand you have to actually learn. And you have to learn how to identify, for example, whether a level is going to hold or whether it's going to break. And again, it's almost opposite to what the books teach you, which is not correct. Some of the books that, I mean, I haven't seen a book that actually teaches it correctly. So what happens? So this is an approach that you could do. If you know that there's a bunch of sell orders sitting here that haven't been filled, I know one thing, they're sitting there. And if price runs up into this area and there's more willing sellers at this price level than willing buyers, I know price must drop. The only way that price can trade above this area is if there's no more sellers with orders to be filled in this price zone. It can't be. It can only go above here if there's no more orders left. So if I can identify with a high degree of accuracy where those levels are on the charts, that's pretty good. So let me show you some charts, and then we can show there's levels drawn ahead of time so you can see, you know, what's working and what's not. For example, let's look at the Aussie dollar. And we're actually in the long side of the Aussie dollar. We bought it at the beginning of the week. We bought down here. We bought again here yesterday. And some people in the room bought again here today. And some people bought even on a 15-minute here. And we're still moving higher. I put this trade out. I was on a webinar on Monday and I said, this trading idea, this is likely to go higher based on trend. This is trending to the upside. This level may break, it's likely to break, and we're likely to move higher. Why? This is a supply level. Prices drop from here. Why is it likely to move up? And again, I can't say everything today, but there's reasons once you know how to read this, knowing that the odds are more likely for it to break to the upside. So if you want, go and watch this on a day-by-day basis or on a week-by-week basis and see how this is playing out. It may drop down from here, but the odds at the moment are it's going to break above this level, okay? And it's very much similar to this level. This is supply. Prices dropped. Prices came back up to this level and dropped. And again, but over here, we took our buy trade and we played it to break this level. Most people are taught that the more times price goes back, the stronger this is. So you tell me from your experience in the market if that's true or not. Why would price break it? And then we have a level over here, which we kind of stopped at and kind of came down and back. But the odds here were likely to go higher based on trend and based on supply and demand. And we'll have a look at a couple more markets. And again, it's the same thing. This is a euro. It's the same thing with the euro. It's taking a bit of time to load up. And we have levels, supply and demand levels. Look at this. We have a level of supply, price ran up here and dropped down, and then we broke it. And we have levels here of demand, and then eventually we break this level is what we talked about, and then we came, back. And so knowing how to identify these levels ahead of time, for example, we hit a weekly supply level here. This is supply. Look what happened. Yesterday and today, we dropped down. Some people shorted this. Okay. So knowing how to identify these levels, and here we have a beautiful uptrend, very interesting pattern here. The pullbacks with the tails up and down. Don't see that very often. Okay, you got who's in control here. The trend is your friend until the bend in the end when it reaches supply. Markets move between demand and supply levels if you can identify them. If you're trading the news, it just happens quicker. And we can look at any market and see similar things. This is supply. Prices dropped. So when prices come back once, they drop. Twice, they drop. And you see all these different levels in the market and on different time frames. Why did this stop going down? We reached demand level on the weekly chart and we moved up. We happen to be trending to the downside though, and now we're going sideways. And you can see that here intraday. So let me ask you something. Just type a yes in the room if you've learned something new with what I've just covered now, something that will help you going forward with your trading, a different perspective, something fresh that will really help you going forward, maybe a different belief system, a different view of the markets. It's just a supply-demand equation, and your job is to understand where those levels are. Michael, you know this stuff already? Great. Okay, so let me move on to the next part. And I want to share with you the offer of the trading room. So I'm going to take you through this. So you've now discovered a simple and powerful approach to reading the market using supply and demand. So I invite you to follow along with me on a daily basis. So you can join our trading room. Now let me explain why you may want to join this. And everyone, I'll tell you something interesting. We've had a very good run. We piloted the trading room with a very small group of traders for a few months. And we actually launched our trading room last month. And we have at the moment a few traders in there, but we've had a very good track record. Every single trade that we've called up until yesterday, we've had a complete no losing trades. We had our first losing trade yesterday in 3 months. Okay, for those of you who are in this webinar that, you can vouch for it. Everyone, it's, we call out the trades and we had our first losing trade yesterday. So why should you join our trading room? So you can learn by watching us analyze and trade the live markets in real time. And these are the markets that we cover. I primarily focus on Forex, but we look at futures as well, oil and gold, and we look at the S&P 500. And we can look at any New York Stock Exchange or NASDAQ, any American stocks. So if you want to look at stocks, we can look at whatever you want. But we primarily focused on Forex and futures and oil, gold, and the S&P 500. We also look at different time frames. For example, if we're looking at the charts and a long-term trade is setting up, like on the Aussie dollar, we'll mention it. This is a long-term trade that you may want to be in for a few months. And we also look at swing trades. We may take a trade that we're in, for example, the Aussie dollar is a swing trade, and it's a long-term trade. So you can take it, and you can also take it as a day trade, which is a short-term trade. So again, it depends how you want to trade, what fits you. You can trade. So we'll point out trades in the room that are setting up on the bigger time frames, which are more long-term, swing time frames, which maybe you may be in for a few days, a day, a few days, and short-term, you don't hold anything overnight. It's open participation. You can ask your questions in real time, and people do, and we can answer any questions that you have. And let me just share with you what people are saying here. So we have Yangos from Cyprus. He says, being in the trading room with really skilled traders like Simon and Mike, Mike's someone who's been with me for about 7 years now, is a great experience. They go through the market analysis thoroughly and in detail with amazing teaching and communication skills. They explain to you what the market is doing and the different probability scenarios that might happen. Simon is very good at telling you what mistakes to avoid, giving you the right advice on the technical, but also on the psychological aspect of what you need to do to improve yourself. His vision is to build a big family of top traders that can work together, grow, make money, and have fun doing it. Very important. We have fun every day. The trading room is perfect for anyone, regardless of where you are in your trading career, as everyone needs a hand of support in the long journey of becoming a master trader. And this is what you'll be able to do with this knowledge. You'll learn how to read any market, Forex, futures, or stocks. You'll learn how to find high probability trade setups, because we do them. We find them every day. You'll be able to trade in all market conditions, not just trending markets. You'll be able to trade in, if you go through a year with us in the trading room, we'll see many different market conditions, and we'll be trading in choppy sideways markets. We'll be learning how to trade in the right way in choppy sideways markets. We'll learn how to trade in trending markets and other market conditions. And we'll learn when also not to trade, when the market's not really conducive to high probability trading. You'll be able to engage the market with precision. You'll know exactly where you should be entering a trade, and you'll know exactly where you should be getting out in profit, or if it moves against you, as a stop. You'll understand not just how price is moving, you'll understand in a deeper way why price is moving as it is. You'll be able to manage your risk, correctly place your stops. Again, most people think that a stop is there to stop you losing money. That is not correct. It's an incorrect belief system. Stops are there not for that purpose, because you could put a stop in the wrong place and then lose money instead of making money, because you put your stop too close to your entry price. It stops you out, and then it goes all the way to your target. So a stop is not there to stop you losing money, because if your stop gets hit, you do lose money. Stops are there to take you out of a trade where the idea is no longer valid. Risk management and position sizing is how you manage your risk on the money side. Placing a stop has got nothing to do with position sizing or how much money you're going to risk. You can position size with a wider stop to risk the same amount as with a smaller stop. If you put your stop in the wrong place, you'll get stopped out most of the time and be bait for more professional traders who will hunt your stops. And those of you who've traded for some time will know that when you get stopped out and the stop turns around right where you got stopped out and goes straight to your target, and you watch on the sideline, it's very frustrating. And you'll learn to trade with the odds in your favor and trade with confidence. And you'll also be able to master the mental game and much, much more. So this is how you can join the room. There's 3 different programs. Each one starts with the 2-week trial. If you don't want to continue after the 2-week trial, just cancel it anytime in the 2 weeks, and you don't have to continue. So it's a monthly subscription after that 2-week trial, $497. If you want to lock in a whole year, you get a 50% discount. Or if you want to lock in and just do 6 months at a time, you get a 30% discount. So again, it's up to you. Come try the room for 2 weeks and see if you like it, see what you can learn. We have some people that are beginner traders in the room, and they're learning it and they're loving it. And if it's not for you, then you don't have to stay after the 2-week trial. Okay, I know a lot of rooms out there do free trials and everything. I want people to come in that are committed, even on the 2-week trial. So if you show commitment, we're building a wonderful community of growing traders. So again, I believe in life, you get out of life what you put into life. Yeah, so if you're willing to go a little bit and show a commitment, you'll get more out of it. You'll take it more seriously, and it will be better for you. So here's a link that you can go to. You can go to TradeSmartForex.com, live trading room, and let me just show you what that looks like. 1 second. So you can go either to my website and click on live trading room, and that will take you to this. So I can put the link in the room for you. Are you ready? Put it in the room. Great, excellent. Thank you for that. And you can, there's a little video sneak preview of the room if you want. And you can click here and it takes you to whichever program you want. Most people will start out on this and see if it's for them. If after the 2-week trial you decide you want to move over to one of these, then you can. It's much cheaper to do that. And imagine where you'll be with your trading, say if you join the room for a year and you watch us trade live every day. The room runs at the moment, we run it on Sunday. We prepare for trading for the whole week on Sunday. And then we actually trade from Monday to Thursday at the moment for the US session. So we start like at 7:30 a.m. Eastern time, and then we go for usually an hour and a half, maybe 2 hours sometimes, depending on what's happening in the market. Okay, so what I'm going to do now is, again, go to this link over here. It's in the room. Click on it. If you have any questions, you can feel free. You can send me an email, and I'll put that into the room as well. So that's my email. And let me open up to any questions. I think we've got a few minutes for questions. So if you have any questions, feel free to put them in the room now. No, I'm not connected to TradeSmart University. Oh, so what time is the room open? We're a very focused room. We're trading the US Open primarily, and most of the time, you know, like it doesn't happen every day. Sometimes there's no trades to do, but we have trades. We can sometimes be in 3 trades off the open and done within an hour. And we've done that 2 Mondays, which is generally not the best trading day, but 2 Mondays, we've had 3 trades open, you know, off the open, and yeah. Okay, so I'm looking for any questions here. Yeah, what you see behind you is Thinkorswim. It's one of the platforms I use. I use it, yeah, but I trade off other platforms as well. Yeah, Ron, you should, you know, Forex is a great market. It's, you know, it's a 24-hour market, but it doesn't mean that you should be trading 24 hours a day. So the room's open every day again and then it's all the sessions, you should know all the sessions are recorded. So if you miss a session, you can actually watch the recording and see what trades we do. We do the preparation session on Sunday. If you can't make it at the time that we do it, you can watch the recording before the open on Sunday night, Monday morning. Bill, you can go, and this is another thing. I have a YouTube channel, and I have some videos there. Let me just put this up. Oops, let me just get this back. Okay, so you can go, I have a YouTube channel here, which you can go to. I can put that link in the room as well. Okay, on the YouTube channel, you'll see I put out a video once a week about where the dollar's going next, and you can see all the probabilities and everything for that. So you'll learn a lot about reading the market and supply and demand by watching these. You can also watch some previous webinars, timing research show or whatever. There's some webinars about how to trade professionally here. So again, go and have a look around, and there's a few live trades here. So join the channel. I put out video once a week on Sunday. But if you want to see us in action every day, then come and try the live trading room. I think we're pretty much time. So thank you very much, everybody. Thank you for joining me here, and thank you for the MarketFest team for organizing this. It's great to be part of it. And thank you all for attending.